Hi, everyone. I'm Diane Brady. I'm here with Steve Forbes, who is, of course, Chairman, Editor-in-Chief of Forbes Media. Most recent book being Inflation. I believe, Steve, that's your 8th book. Is that right?
That's right.
Prolific. We're talking about the news that's come out, floating this idea of a common currency in Latin America, initially with Argentina, Brazil. Is that likely to happen in your mind?
Sadly, in the short run, no. They've floated the idea of a common currency in the past, usually aiming it against the dollar. The intellectual argument for a common currency is irrefutable. All you have to do is look at the United States. Imagine if each state in this country had its own currency, its own central bank, how much less off we'd be. Common currency makes it possible to easily flow capital around, usually means easier to flow goods and services around. So you have more prosperity. And everyone points to the euro, but that took years to do. And the reason the Europeans did it was because with the collapse of the old Bretton Woods monetary system, where you had fixed exchange rates with floating exchange rates, it was just chaotic in Europe. They do a lot of intracontinental trade. Mm-hmm. And so having these floating rates meant much more expensive to do trade. You had to hedge and everything. So they created a common currency. And even European Union countries that aren't on the euro usually track it pretty closely. Bulgaria has got a currency board, so it's directly tied to the euro 1-to-1. Denmark almost does the same thing. So a common currency just avoids a lot of problems. But unfortunately, there are a lot of misconceptions. And there's a lot of nitty-gritty detail to make it happen.
Well, let's talk about that, because I know with the Eurozone, one of the misconceptions that you've written about in the past is this idea that the issue was that the monetary union didn't also have, in essence, a fiscal union, so that somehow constrained these countries from doing what they had to do in tough times. How is that wrong?
That's exactly right. And you don't have to have a common fiscal policy, financial or tax policy to have a common currency. Just take this country, for example. Look at the governance in New York or Illinois versus Florida and Texas. And you can see the differences there in terms of tax policy, spending policy. For example, Florida's budget, even though Florida has a bigger population than New York now, Florida's budget is less than half of New York's budget. Mm-hmm. So the European Union put in these rules about deficits, which got violated. And the other big thing that they did was to leave out the conception that because they had a common currency and a new central bank, therefore, this new central bank and countries like Germany would be there to bail out weaker members who got in trouble. And that didn't have to happen at all. It caused huge problems 10 years ago, 11 years ago in 2011, when the Greece got in deep trouble. They prescribed all the wrong things, put it through a depression, and bailed it out. And so in this country, let's say Illinois or New York gets in a crisis, doesn't mean you have to go bail them out. Detroit went bankrupt and didn't mean you bailed it out. And this idea that, if you have a different currency, you can get out of these crises more easily. Again, a falsehood. That just leads to a hyperinflation. So if, say, poor Illinois got in trouble, no one is suggesting that Illinois leave the dollar zone and have its own country, the Illo peso or something like mm-hmm. that. So the thing is, there are a lot of misconceptions that made this experiment much more difficult, and still leaves this currency union in somewhat shaky shape. That even though it's lasted for quite a while, these misconceptions could lead to either some kind of Brexit. And you always have the Italians saying, we should be able to devalue our currency and get out of our problems. No, all you do is get a hyperinflation. So right. Keep the currency stable.
Let me, 2 points you just mentioned. Let's start with Brexit, because, it was never part of the Eurozone per se, but what impact has that had? Is the UK really sort of following the lead of some of the other countries, in essence, pegging so that it's tantamount to having the stability one might get from being in the Eurozone?
It's not rigid, but they do tend to go in one direction. For example, when the dollar had a huge surge for several months until a few weeks ago, the euro went down and the pound went down with it. Now that the dollar's weakened a bit, the euro is going up and the pound is going up a little bit. So in terms of trade, governments want stability. It just makes life easier in terms of trading with one another. And one of the dangers we're in right now, you got a country like Japan, which has a national debt now twice that of the US, still wants to keep very low interest rates. That can cause currency volatility. So whether currency goes up or down, if you're a trader, you're an exporter or importer, it becomes more expensive to hedge against that kind of volatility, which makes things more expensive, and therefore you get less commerce, less trade.
There is this almost whimsical, or I should say aspirational nature when people talk about a common currency. And the dollar zone in some ways extends outside the US because there are many countries, or several countries at least in Latin America and elsewhere, that use the dollar in essence as their base currency. Is that a good substitute for having, in essence, a regional currency in Latin America?
Yes, you touched on something that most people don't realize. Panama uses the dollar and has for over 100 years. In recent years, El Salvador and Ecuador have formally dollarized, where that is the currency. And even in those two countries, when you had left-wing governments coming in saying, oh, we're going to throw out the Yankee dollar, that kind of thing, they quickly backed off because the populace said, no, we don't trust you. We don't care what our politics is. We don't trust you on the money. Leave it alone. So they backed off. And there's been quite a movement in Argentina to dollarize, since Argentina has been one of the most chronic countries to destroy its currency. They do it routinely every generation. And in these countries with very unstable currencies, you find that a lot of contracts are denominated formally or informally in dollars, because they know that the currency is pretty worthless. So, if you put a referendum today in Argentina, keep the peso, where now they're suffering another hyperinflation, and versus dollarizing formally, the dollarization would win, because people just know it's just a matter of time before they muck things up again. And what that leads to, it leads for a variety of reasons to higher crime, because people then want to keep cash around, like dollars or euros or Swiss francs. That's another trusted currency. And so the thieves know you break into somebody's home and ransack it, you're probably going to find a stash of cash somewhere that people keep on hand because they don't trust the local currency.
Yeah.
So bad all around.
I think about Zimbabwe, when I think it was a month's salary for a loaf of bread at one point. We seem to be in a time still where globalization is dirty word, at least politically, but yet the idea of these regional trading blocks and this closer cooperation, how important is a streamlined monetary policy to having, in essence, freer trade in these areas? Because I think there is a recognition of at least the economies of scale and the power. We're seeing it in Asia. What do you think?
Well, whatever word you want to give to it, now globalization is seen as evil, but it isn't. It's just diversifying your supply chain to get efficiencies. Mm-hmm. By the way, one of the great stimulus for that was the creation of the so-called box. And in freight, containers that we take all for granted, that led to a fourfold increase in trade because it cut shipping costs 50 to 95%, made it easy so you could get these sophisticated supply chains. You could not have today this handheld, which is a virtual supercomputer, without the supply chains that were made possible by international trade and the creation of the box, which looks simple but was profoundly difficult to do. So yes, you may want to move your supply chains to more to different countries. Like there's a lot of talk about doing more and more in India and elsewhere, rather than relying so much on China. But the need for having this diversification is absolutely essential if you're going to get economies of scale and lead to a higher standard of living. That's why, again, even though we have an era of floating rates, you have in Africa, led by the French, 14 countries that have tied their currency to the euro formally. Mm-hmm. I mentioned some currency boards like Bulgaria, and you have the creation of the euro. And countries do try to keep their currency closely aligned to that currency with the country they're doing the most trade. And so it just makes life easier. It's like imagine having each state in this country having a different measuring system. Some have the metric system, some have another system, some invent their own system. So you go to buy something, you have to figure out, translate, what does it actually mean? It just makes it confusing and just another barrier to business.
So let's say I am whether I'm head of the central bank, whatever, in Brazil at this moment, it is a popular concept. It's being floated out there. What advice do you have? First of all, is this where I should be putting my attention, the idea of trying to create the conditions for a common currency, or what's the most effective way to achieve the outcome that's supposed to achieve?
Well, that hits on which is going to affect the lead country. In Europe, it was Germany. Mm-hmm. Germany likes stability. And they wouldn't trust the French with a central bank. They wouldn't trust Italy with a central bank. But the Germans, they figured, okay, we'll use the spirit of the Germans to run the European Central Bank. And even if it's not a German running it, it's got to be somebody with Germanic-like attitudes to.
So trade will run on time.
Yeah, in the case of Latin America, where would the central bank be? By rights, the Argentines think, even though they have trashed their economy, trashed their currency, they think it should be in Buenos Aires. The Brazilians, who think they have their own universe, huge country geographically in terms of population and everything else, would want it in Brasilia. And so in terms of making it happen, if Brazil said, yeah, this would be a good idea to try to make it happen, the way they should do it is to continue even more formally and more rigidity. In recent years, the Brazilians have tried to keep their currency relatively stable against the dollar. Mm-hmm. They realized in the past what has led to when it's no path to prosperity, it's a path to ruin, dictatorships and the like. So they should say, well, we know it's going to be difficult to have formal negotiations, but one of the things that would make it easier in the years ahead is if people say the Brazilian real, that's as good as gold. That's as good as the dollar, or even better. And so if you have a stable currency, that leads to growth, and that leads to like a magnet to neighboring countries will say, well, we want to tie to this. We can start to trust it. So what Brasilia should do, the Brazilian central bank, is try to even more make the real stable against the dollar, just peg it to the dollar. But one of the things that makes this all difficult is that countries still have the illusion that if they manipulate their currency, that helps stimulate the economy. If you have a recession, we'll cut interest rates and create more money, and that'll stimulate recovery. No, it doesn't. If you just remove the barriers to internal trade, regulations and taxes, many of these economies, for example, you talk about Brazil, are very, very statist-oriented, full of regulations. And you have to then create an environment where you can either repeal those or get around them. Two countries that were rigidly regulated for years was India and Israel. Mm-hmm. And the result was economic stagnation. And so what they did was those rigid regulatory regimes was that they made sure that there are no regulations or few around high tech 20 some odd years ago. So India, boom, is a high tech center. Mm-hmm. And Israel, they have more companies listed on NASDAQ, especially for a country of its size. Israel, in effect, is a greater high-tech powerhouse than the European Union, which is preposterous. But that's what happens if you allow things to open up. So that's what Brazil should do, remove the barriers. And so we'll, again, let the magnet work. And then the creation of a common currency will be a lot easier because an effect will start to happen in the street. In Argentina, the sign will be when, yeah, they may use dollars, but they also wouldn't mind using Brazilian reals.
And they go into the bank. Let me take this full circle and go back to the U.S. dollar, because I recall when I lived in Hong Kong, that was the height of the debates around how China had pegged, its currency in a way that seemed to game the system. Now we're seeing these China and Russia essentially try to move away from the U.S. dollar. Are there lessons? I think of you as my go-to person on thinking about currency and monetary policy. Here we are in the U.S. right now, watching the dollar that's been very strong start to weaken slightly. What is the end game here when you look at the appetite for U.S. dollars and this default currency role we've played for so long?
Well, you mentioned Hong Kong. As you know, in the early 1980s, Hong Kong created a currency board. And they rigidly tied the Hong Kong dollar to the US dollar. And it survived the Asian crisis of the late 1990s when other currencies were falling by the wayside. The Hong Kong dollar held up. It is so far still holding up, even with the troubles there now, the political troubles. Mm-hmm. And so that has worked. Currency boards work if you follow the rules. Argentina tried sort of a currency board, by the way, in the 1990s. They didn't follow the rules. And of course, the thing then blew up. So and so in terms of China, for years, China had trouble in the early 90s. And so in the mid 90s, they decided, in effect, to farm out their monetary policy to the Federal Reserve. They fixed the yuan to a certain range against the dollar. And we got all huffy and puffy about it. Again, not realizing that that they said, oh, that means China's cheating because the currency should go up since they have a surplus. No.
It means it's predictable.
Well, and so China may have a surplus in terms of merchandise trade, but then you have capital flows. The U.S., people forget, has had routinely trade deficits since our creation most of the time, but we had capital flows to counter that. So just ignore that. You mentioned Hong Kong. Decades ago, there was a governor of Hong Kong, back when it was a colony, crown colony, mm-hmm. who forbade the bureaucracy from getting statistics on trade and certain other things, because he said, what you're going to do with the numbers, you're just going to feel you have to do something and muck things up. And
I didn't know that. Was it Chris Patton by any chance? A predecessor to him?
It was a fellow named Sir John Copperthwaite.
Oh, okay.
Back in the 60s, when Hong Kong was still in the very formative stage. And
lying with statistics.
He said you're just going to start doing things that are going to make things worse. So just let it unfold, and it did brilliantly. So in terms of again, going to what China did, is they were in certain areas very efficient, and but again, we sometimes people look at currencies like stocks. So if the economy is strong, therefore the currency should go up. If the current economy is weak, it should go down. No, you should just keep it fixed. And but going back to the 60s, when we had fixed exchange rates, we didn't understand that. So we're always beating up on the Germans and the Japanese, saying, oh, you should revalue. Well, we got our wish in 1971, 72, when we took the dollar off the gold Bretton Woods standard. We had floating rates, and we got a lot of inflation. And we've had a lot of inflation since then. We've had periods of low, but then it comes back again. You never have it when you have a good monetary regime. And by the way, in terms of the dollar, even though the dollar fluctuates, it is still the currency of choice by default around the world. Most of our currency today, in terms of dollar bills, especially the Benjamins, the hundreds, mm-hmm. are used outside the United States. And it's not just for illicit activities. It's a currency of commerce.
Yep. Trusted currency of choice. So it's good advice, and obviously getting one's house in order is always a a good thing before you start looking to your neighbor for relief. So thank you for thanks for joining us, Steve. I don't know if there's anything else you want to add in terms of course, not just advice to Brazil, but we are in a period where we're looking at what is the right mechanism going forward, since we're still some concern about recession. Anything else you would want to add about the role of monetary policy in either exacerbating or getting us out of this?
Well, the idea that you can use monetary policy to guide an economy, steer an economy like you would a truck or a car, is one of the great misconceptions, preposterous ideas of modern economics. And all it does is get you in trouble. And when you have stability, you move ahead. It just makes life a lot easier, much more predictable, and makes it easier to have long-term investments instead of just looking short-term. When anyone asks me, should I invest in gold? I know we have a problem. You should not be investing in gold. Gold you buy as an insurance policy against the idiocies of central bankers who should know better but don't. So in the case of the U.S., hopefully the Fed will back off. They do believe you've controlled inflation by depressing an economy, which is nonsense. We did that repeatedly in the 1970s. You know, I know there's an aside, but in '74, we went through a severe recession, very high unemployment, the highest
inflation,
and got stagflation. And what would happen? Yeah, exactly. What would happen is, okay, you depress the economy. That brings down prices because people can't buy anything and businesses are going out of business. But then when the prices came down, they undermined the stability of the dollar. And so we got the problems again. So one of the myths that the Fed is that, by golly, in the early 1980s, the great Paul Volcker put through the U.S. to even more wrenching recession, finally killed the inflation. No, it wasn't the recession that killed the inflation. It was what Paul Volcker did after the recession. He relatively stabilized the dollar. And so for a while did his successor, Alan Greenspan. And that combined with pro-growth policies on tax and regulations. And the economy boomed. The dollar was trusted again. And we in the world did very nicely. So the lessons are there, but we have some students who keep needing remedial education.
Well, hopefully this will do the trick. So thank you again for joining us, and I look forward to continuing the conversation. Thanks, Steve.
Thank you, Diane.